Today's lecture, we're going to focus on universal life and in regards to the death benefit options that are available on universal life. One of the unique things about universal life is the fact that in actual fact you have 4 different choices in which way the death benefit could actually be paid out. So one of the unique features, you might say, of universal life is that you really have 4 different ways of actually getting a death benefit options. Please note that these options must be chosen at the beginning. In other words, at the time that you're actually taking the application, because the insurance company, of course, has to underwrite these particular death benefit options. So they must be chosen at that time and cannot be changed later on. In other words, once you've got it, and that's basically it. So let's take a look at each one as on an individual basis. The first one is what we call the level death benefit option, which is essentially the face amount of the policy. So in other words, if you're insured for $500,000 and you die, you get $500,000. It doesn't pay out any cash value, any account value, anything along that line. It's strictly the death benefit, the face amount of the policy. The second one, which is probably the most important one, I stress to that, is the level plus account value. In this case here, not only do you get $500,000, let's say in an example, but you also get whatever the account value happens to have as well. You'll recall that the account value is the sum total of all of your deposits, investment income. So in other words, the account value increases as the investments increase. Person dies, and let's say at the time of death is $50,000 in the account value, they'll get the $500,000 along with the $50,000 account versus this one here, which is basically simply the level cost only, and that's it. The next one is, again, very popular, is level plus deposits. This is really, again, the $500,000 plus the total of all of your deposits. Now, I said total of only your deposits. No interest, again, is strictly your gross premiums. Whatever you paid up to the point of the person dying, they'll simply add up all those premiums. And let's say it was $20,000, so you get $20,000 back, along with, again, the face amount of the policy, in our example, the $500,000. The last one, which is probably the one that's least, because of the cost of the insurance here, is what we call level plus indexing. This is really for the individual who's basically saying, I'm concerned about the purchasing power of my $500,000 because of inflation and everything. So therefore, I want you to index it. In other words, go according to consumer price index, or perhaps a predetermined number, 3%, 4%, and so on and so forth, okay? So this is really for the individual who's really not so much concerned about accumulation of cash, really more concerned about making sure that the purchasing power is maintained. So when they die, that $500,000 still buys $500,000 worth of goods. It's not being actually impacted by inflation. So in summary, what we've got is 4 options: level plus account, level plus deposit, and level plus index.